What if you could invest in the entire stock market, hundreds of top companies like Apple and Amazon, with a single click and for less than a pizza? For years, investing seemed reserved for Wall Street pros, while most people felt left out or lost money chasing hot stocks. But here's the truth: you don't need to pick winners to build wealth. In fact, even the pros rarely beat the market. The real secret: stop searching for the next big thing, just buy the whole market. This is where exchange-traded funds, or ETFs, come in a simple, low-cost way to own a slice of hundreds of companies at once. Let's break down how ETFs work, why they're so powerful, and how you can use them to start building wealth. No jargon, no hype. So, what is an ETF? It's a bundle of investments, stocks, bonds, or commodities, wrapped into a single fund you can buy or sell on the stock exchange, just like a regular stock. With one purchase, you own a little bit of a lot of things, instantly diversifying your investment. That's what makes ETFs such a smart starting point for beginners. Think of an ETF like a fruit basket. Instead of picking individual apples or bananas, stocks, you buy a ready-made basket with a mix of fruits. For example, an S&P 500 ETF is a basket holding shares in 500 top US companies: Apple, Microsoft, Amazon, and more. Buy one share, and you own a slice of all of them. If one company has a bad year, the others help balance it out. This built-in diversification is your safety net. With ETFs, you're betting on the whole market, not just one company. ETFs are traded on stock exchanges in real time, just like shares of a company. They're managed by big financial firms like Vanguard or BlackRock, who assemble the basket to match a specific index. When you buy an ETF, you own a piece of all the underlying assets, real stocks, not just paper promises. The price of your ETF rises and falls with the value of the assets inside. Most ETFs are passively managed, so fees are extremely low, sometimes just a fraction of a percent per year. That means more of your money stays invested and growing. The ETF world is like an investment buffet. There's something for everyone. Index ETFs track broad markets like the S&P 500 or MSCI World, giving you instant global exposure. Sector ETFs let you focus on industries like tech or healthcare. Gold and bond ETFs offer alternatives to stocks, adding stability or inflation protection. International ETFs let you invest in markets outside your home country for even more diversification. With ETFs, you can build a portfolio tailored to your goals, risk level, and interests. Start simple with a broad index ETF, then add other types as you learn. That's the power of choice without the complexity. Why are ETFs so popular? 5 big reasons. First, instant diversification. One ETF can give you exposure to hundreds or thousands of companies. Second, liquidity. You can buy or sell ETFs anytime the market's open. Third, ultra low costs. Fees are tiny compared to traditional funds, saving you thousands over time. Fourth, transparency. You always know exactly what you own. Fifth, tax efficiency. ETFs are structured to minimize taxable events, so more of your gains stay yours. These advantages make ETFs a powerful foundation for any long-term investor. Simple, flexible, and built for growth. No investment is risk-free, and ETFs are no exception. The main risk is market risk. If the market drops, so does your ETF. The best defense? Invest for the long term and don't panic during downturns. Watch for tracking error. Sometimes an ETF's performance lags its index slightly, but reputable funds keep this minimal. Liquidity risk is rare with big ETFs, but avoid obscure, thinly traded funds. And remember, ETFs are for long-term investing, not day trading. Stick to a buy and hold plan, automate your investments, and let time do the work. Awareness of these risks helps you invest smarter. ETFs versus mutual funds. What's the difference? ETFs usually have much lower fees since most are passively managed. You can buy or sell ETFs anytime during market hours, while mutual funds only trade once a day. ETFs require no big minimum investment. Start with the price of a single share or even less with fractional shares. ETFs are more transparent, showing holdings daily, and are often more tax efficient. For most beginners, ETFs offer more flexibility, lower costs, and easier access. Mutual funds still have a place, but ETFs are hard to beat for simplicity and value. For long-term, hands-off investing, ETFs are the clear winner. Ready to get started? Here's how. Open a brokerage account. Most are online, quick, and low cost. Fund your account, then pick a simple broad market ETF, like one tracking the MSCI World or your country's main index. Find the ETF's ticker symbol. Enter it on your broker's platform, choose how much to invest and click buy. Congratulations, you're now an ETF investor. The real secret is consistency. Set up automatic monthly investments so you keep building your portfolio over time. This dollar-cost averaging smooths out market ups and downs and keeps you on track. Be patient, stay the course, and let compounding work its magic. We've covered the essentials from what ETFs are to how to buy your first one. You don't need to be a financial expert to build wealth, just disciplined, patient, and willing to start. ETFs offer diversification, low costs, transparency, and accessibility, removing the old barriers to investing. The most important step is action. Open an account, fund it, and make your first ETF purchase. Invest regularly, automate your contributions, and let time and compounding do the heavy lifting. This isn't just about money, it's about building freedom and security for your future. The journey starts now. Keep learning, ask questions, and most importantly, get started. Your financial future is in your hands.